Hey guys, what's up? Alec back with the daily stock market, and look at that, Netflix down to $165 per share, and from highs, they're down 75%. So we're going to talk about Netflix and if it's possible for them to be a huge comeback story in the stock market. They have potential to raise 100 to 300% gains in the span of 12 to 24 months. So we'll talk about the risks and rewards involved. We'll also talk about a couple other stocks that are down 75% or more and have some huge bounce back potential. Now, of course, there's always rewards involved with stocks like this. We'll make sure to talk about the risks involved in this video also. Make sure you hit the like button, subscribe with post notifications on, and let's jump right into the video. So first up, we have Netflix, which we already discussed is down around 75% from highs of around $690 per share. And that was just in the span of 6 months. Netflix has seen a devastation to their share price. For Netflix investors, the return of Stranger Things over Memorial Day weekend has been success with record-breaking numbers and positive reaction, but the larger picture is still hazy. Investors can celebrate a short win, but need to remember the show is nearing its end and the streamer doesn't have a lot of similar marquee shows in the wings. In addition, there are larger overreaching problems still not being addressed, some because they take time, but others because Netflix seems to be reluctant to change its strategy. Okay, so if we pull up Netflix income statement, if we look year over year, we can see the growth has been consistent to around 20% per year on total revenue. On net income, it's been even better, with average growth totaling around 50% or more over the last 5 years, consistently every single year. But that's year over year. Let's look at quarter over quarter. If we go ahead and look at quarter over quarter, you can see on total income, they have been struggling a little bit in the last 2 quarters, going down, especially in 2021 Q4. The most recent quarter, they bounced back pretty strong. If we look at total revenue, obviously the growth isn't there. That's expected quarter over quarter, but they still are at an all-time high in Q1 2022 for revenue, which is a great sign to see the growth, even if it's a little bit slower than anticipated. If we scroll down to the balance sheet, still a pretty good balance sheet, 61% assets to liabilities. So I would like to see the assets a little bit higher or those liabilities a little bit lower. Remember, we also have rumors going around that Netflix could acquire something like Roku. Every few months, we usually see rumors around some combination of big streamers making a move to buy a rival or sell themselves to another one, and nothing happens. Reports surfaced this week that Netflix may be on the verge of acquiring Roku, and while shares of Roku popped up, this could be a case of buyers beware. The thought here is that Roku ad business could jumpstart Netflix entrance into the ad space, making for a marriage of convenience, but there's more to consider. Netflix recent poor earnings reported has forced them into cost-cutting mode, eliminating jobs and overall content. Not exactly the best time to spend billions on an acquisition. Okay, that's a really good point. In addition, part of Roku's earnings come from detailed ad revenue sharing deals and access. Overall, we see analysts with a 70% upside with a price target of $285 per share in the next 12 months, which is pretty aggressive. We see some recent analysts have price targets closer to $170 and $160 per share in the next 12 months. So you can see some risks where some analysts are saying. We even have a 5-star analyst at Goldman Sachs saying $168 per share in the next 12 months. And he has an average success rate of 62%, which is pretty high in this industry. We have Mark Mahalany, which is a 5-star analyst with 50% ratings, with a price target of $295 per share. We have a JPM analyst coming in, Doug, with a price target of $300 per share, 56% success rating. We have Bank of America's securities saying $240 per share, but these were reiterated just a month ago, and a lot of price action and capitulation has happened with Netflix, in the last 30 to 60 days. So overall, we have Netflix sitting at a 5-year low. It's like traveling back in time to 2017 and buying at a 5-year low. And we've looked at the income statement. We've seen the net income. We've seen the revenue growing considerably since 2017. So I think the fair value on Netflix is closer to $250 per share to $350 per share. And I think those price points could easily be achieved in the next 24 months. This is really a long-term hold. There's a lot of risks involved because of the downward momentum that Netflix has already had. And it could definitely continue under $150 per share. I have price alerts set at $150 per share and like $125 per share. After $149 per share, which is basically the lowest support in the last 5 years, that will be a very bad sign for Netflix if we do see them get that low. The next one up is DraftKings at $11.50 per share, down 80%, 83% from highs. Absolute catastrophe that's happened to the share price. We also have a pretty hard support right at $11 to $9 per share, close to where it IPO'd. Definitely be wary on this one because there's still a chance that DraftKings could go below $9 per share, especially in the markets we're in. With the 80% drop, the risk versus reward is a lot more attractive for something like DraftKings. We also see the market cap is now only 4.7 billion, so a bigger company could come in and scoop them up. The idea that DraftKings stock has fallen so far that the downside risk is minimal compared to the possible upside risk is a flawed notation. DraftKings cash pile continues to burn at a ferocious rate, and it could be ashes by 2023 and force the company to borrow heavily at high cost. DraftKings sees big gains from new legalizations, not necessarily the case. Addressable population numbers are far too optimistic. In Q1 2022, DraftKings reported a loss of $467 million with a negative cash flow of $356 million, which is absolutely devastating, and you do not want to invest in companies reporting numbers like that, especially in the market currently is not favoring companies like that at all, which is why DraftKings has sold off 80%. Management keeps upping guidance on a revenue for the full year between 1.9 to 2 billion, sustaining its surging top line between expectations for customer retention and also its best case scenario outcome for the new markets named above. That is certainly fair enough, but its annual cash burn run rate sits at 1.4 million against its 1.7 billion in cash. If it's promotional and marketing costs, debt and the amount they're paying on debt is a huge concern and a huge risk for DraftKings. You might want to wait a little bit longer to see how low DraftKings can go. On an intrinsic value DCF analyst by various sites, DraftKings is valued at $17 to $20 a share. Normally, it would appear to be a fair estimate, but it is a thumbnail on the scale number in our view. Because it projects over the next 5 years, a cash flow build that simple can't estimate when it will turn profitable. No projection can be certain how and when DraftKings management will decide to begin biting the bullet on costs. Nobody can tell what barriers to entry will fail for new players in the space. Nobody can tell how many platforms will survive the inevitable consolidation. We do believe that DraftKings will be among the survivors in the top tier of 5 market share sector leaders. So thumb off the scale, rose-colored glasses swept away from the eyes. What's the ultimate weight of DraftKings for investors? The company is a great candidate for a merger or takeover at its current price. An attractive premium can be found that makes sense for all investors and insiders. CEO Jason Robbins has told the market that if it was permissible, he would be a buyer. Okay, if for the right acquirer, you could get a $2 billion business with 2 million monthly active users. That shortened of its excessive marketing spend could be a solid money maker and deal. In the process, it could mean tossing a given chunk of non-profitable revenue that would be immensely preferable to investors who would like to see returns that include big stock buyback programs. perhaps even dividends way downstream. Investors who see that scenarios have a good reason to stay in the stock, even though, in my view, there are still some downside risks ahead. That's why you might want to wait a little bit before jumping in DraftKings, as new state legislation could disappoint. Otherwise, as the market in general appears to be at the cusp of what could be a major dip or worse, and no real prospect of dramatically slashed promotional costs appear, it is a sell. Okay, so that was one analyst opinion. Here we see on average the analysts have 152% upside on something like DraftKings over the next 12 months. However, these were mainly reiterated more than 30 days ago, which is never a good sign. A lot of these are $30 price targets. A lot of these are 5-star analysts coming in from Morgan Stanley with 57% accuracy ratings. Yes, so a lot of these are 5-star ratings. And I would say my prediction is closer to $17, $15, $20 per share, somewhere in that range in the next 12 to 24 months, which could see huge gains potential if they end up doing everything right. Just to do a quick update on Nike, because I don't want this video to go on too long. We have Nike at $110 per share. We see them down 15% in the past year. And on the 5-year chart, we see them closer to $52 per share. So the question is, can they peel under $100 per share? We see supports even closer to $93, $95 per share. We see some as low as $80 per share. So let's talk about it. By the way, we also see a 1.0 dividend yield on Nike with a PE ratio of around 30, market cap of 176, 52-week high of 179. China's lockdown have hurt Nike, Adidas, and why things could be improving. So you can read this article a little bit, pause the video if you want to scroll down, but let's just jump into a little bit more of a detailed article. So the first bearish article we will read, and it's going to say run for the hills. And my suggestion, if you're interested in buying Nike on the 2022 sell-off, the stock's current valuation makes absolutely no sense in high inflation, weakening economic backdrop. Comparative shopping versus shoe company peers reveals Nike's underlying value might be as low as $60 per share versus today, which is closer to $100+ per share. Here we see a more bullish article summary. Nike and Adidas are the two biggest sportswear companies. Nike's scale is a big advantage. Adidas doesn't even come close. Adidas looks cheaper than Nike and has been a better growth story, but there is a reason for Nike's high valuation. Nike is better managed than Adidas and has a way stronger brand name and brand image. It's one of the strongest brands in the entire world, so that's why it gets a little bit of a premium, in my opinion. Nike is a better long-term buy in that analyst's opinion. Here we see an indecisive analyst article that says Nike has been executing well on its consumer direct acceleration strategy, leading to double-digit direct sale growth and contributing to 100 basis points of gross margin expansion. The firm has been committed to returning value to its shareholders through dividend payments and share buybacks, which are both bullish for the stock and the shareholders. Nike is well positioned from a liquidity point of view and has the financial flexibility to tackle potential near-term macroeconomic headwinds. According to traditional price multiples, Nike stock appears to be trading at a significantly premium compared to its peers, which we believe is not justified. Macroeconomic headwinds, including decline in consumer confidence, increasing commodity prices, and the geopolitical tension in Eastern European regions are likely to negatively impact Nike's business in the near term, which we have definitely seen. Consumer spending is definitely down on discretionary products like Nike, for example. And what do we have analysts saying about DraftKings? We have 150% upside in the next 12 months to $30 per share. However, take that with a grain of salt because most of these analysts haven't reiterated their price points in over 30 days. And a lot has happened in the share price in the last 30 days. However, we have a lot of 5-star analysts like Thomas Allen from Morgan Stanley coming in, 57%. Success rating with a $30 price target just reiterated 28 days ago. So like I said, take it with a grain of salt, but it is definitely something to consider. So for me personally, I have price alerts set closer to $80 per share, $95 per share. I'm being patient with Nike. I'm not dying to get into Nike. But if they get as low as $80 per share, definitely cannot pass them up for long-term investing, and maybe even in a dividend portfolio if they get that low as well. So smash a thumbs up on that video if you appreciate it. Subscribe with post notifications on so you don't miss any future videos. We're also going to be posting more option trades on the close friends list more often as well. So if you're looking to get in the stock market and develop a new skill with option trading and becoming a more advanced trader in the stock market, knowing how to do deep dive on companies and seeing if they're a good deal or not, go ahead and message me on Instagram for the close friends list. Couple more spots to fill. Other than that, don't forget to buy low, sell high. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.